I've read them. I actually read all the exchange rulebooks, the major ones people argue about online, but rarely open up. And the first thing that hits you almost immediately is this. The rulebooks literally contain a rule that says the exchange can change the rules. That's not a conspiracy, that's just governance. And there's a specific phrase that shows up over and over: disorderly markets. If markets become disorderly, the board can meet, issue emergency directives, and adjust how the market functions in real time, meaning the rules people assume are fixed. Day to day are not always fixed in a crisis. It's a built-in defense mechanism. And then the second thing they say, plainly, on the websites, in the documentation, everywhere you look is, we are not a source of supply. You are not supposed to treat futures exchanges as your warehouse. Yes, physical delivery exists. There's a process. There is silver in approved warehouses for that reason. But the point of the delivery mechanism is largely to keep the arbitrage between paper silver and physical silver from getting too out of line. It's the pressure valve that keeps the system honest. But this idea that every long silver contract holder could suddenly issue delivery notices and clean out the warehouses, that's never going to happen. And the idea that it would bust the exchange is not how these markets are designed. If you pushed into that kind of stress event, what you'd likely see is the exchange using the tools it already has. They can declare trading for liquidation only, meaning if you're long, you can offset with a short. If you're short, you can offset with a long. Contracts get paired off, the position gets settled, one side writes the check, margin gets released, and it's handled financially. But you don't have a guaranteed right or even a strong expectation that you're going to take physical delivery in unlimited size just because you're holding paper exposure. So when people say there isn't enough silver in the warehouse, the reality is there's exactly enough silver to meet the level of delivery demand the exchange is willing to facilitate. Beyond that, they can simply say, no deliveries, we're netting positions, we're closing contracts. You're not going to break the futures exchange that way. And people who insist that's the plan, that it's some imminent default, they're usually scaremongering a little bit. Now, having said that, it is still a data point. It's one more reason to think silver tightness and silver scarcity may be more significant than what I'll call normal precious metals tightness. Because silver has drivers that gold simply doesn't have, and right now they're all pushing in the same direction. Gold, at the end of the day, is money. It's the best form of money in my view, but it's not useful for much else. Silver is different. Silver is used in wiring, electronics, high-performance components, catalytic systems, defense applications, and in this entire AI, build out the data centers, the processors, the infrastructure, all of it requires a certain amount of silver. Yeah, you need other materials too. Cobalt, copper everywhere, silicon, rare earths, the whole basket. But silver is an input across that stack. So silver has two demand engines. It has the precious metals vector, and it has the industrial input vector. And here's what most people miss. Those two vectors don't have to move together. You could get a recession where industrial demand drops, while monetary demand spikes. Or you could get strong growth where industrial demand surges while precious metals cool off. But right now, the story people are watching is that both are rising. Industrial demand is strong, and investor demand for precious metals exposure is strong. And then there are the non-transparent dynamics, the stuff you hear rumors about. Some rumors have merit, some don't. You hear about enormous physical demand for silver, snorts, that can't be satisfied by paper silver promises. People who sold silver on paper are getting called and told, okay, deliver the metal. And suddenly it's like, wait, I thought this was just a trade. You actually want silver? That's different. Now I have to go find it. That's the kind of thing that can tighten a market fast, and it's coming from multiple directions. I've heard reports, I can't verify them, that China is hoarding silver. Why would they do that? Well, look at the logic. They're competing with the US in the AI race, and the open trading relationship between the US and China in sensitive tech sectors is basically off. Maybe agricultural commodities move, maybe basic trade continues, but in advanced chips, in AI hardware, in that NVIDIA ecosystem, it's not business as usual. So if China wants to keep pace, electric vehicles where they're probably ahead, AI where they're trying to catch up, military applications where they're investing heavily, they're going to need inputs. Silver is one of them. So the theory is they're buying physical, putting it into inventory, and securing future supply. And then you hear another narrative, the one that doesn't hold up when you actually examine how exchanges operate, where people say, the physical longs in silver futures are massively greater than the silver in the warehouse. They can't meet delivery. They're going to default. No. If pressure got extreme, the exchange can shift the rules, limit delivery, and force financial settlement. That's literally what the rulebooks are designed to enable. Now, on price, I think silver continues higher for several reasons. The math example people use for gold applies to silver too. You just scale it. Instead of $1,000 blocks, think in $10 blocks. Going from 90 to 100 is about an 11% move. Going from 40 to 50 is 25%. Those round number levels, 110, 120, 130, once momentum starts, they get psychologically easier. And that's why I can see silver moving to 200 without it needing some impossible set of conditions. And silver also has the gold connection. There's no realistic path where gold goes where I think it can go over time and silver just sits there. If you're talking about $10,000 gold at some point down the road and possibly higher later, silver is not staying at $25 or $30 in that environment. It just doesn't work that way. Silver is going to come along for the ride. It's hitching your wagon to the same macro horse, so to speak. But silver has additional tailwinds that gold doesn't have, because silver is a critical industrial metal in a modern technology economy. Gold isn't. Gold's industrial use is extremely specialized and limited. I visited some of the biggest refiners in the world and asked them questions that almost nobody asks. I once asked the head of Argor Heraeus, one of the largest refiners out there, about ultra-high purity. Could they make 5 nines, gold, 99.9999%? And he said they can, but it's not worth it. The added expense, energy, and processing doesn't create proportional value versus standard 4 nines gold. That tells you something. Gold's value isn't coming from industrial necessity. It's monetary. And it's funny these days, when you start talking about gold, people immediately want to talk about silver too, because the market is connecting the dots. I'm comfortable saying both are going a lot higher over time. There are multiple drivers. Now, does that mean you won't get pullbacks? Of course not. You see these fast moves, you blink and gold's up hard, then you get a sharp 2-day drop. That's normal. Hedge funds don't care if they're trading gold, silver, or coffee. They trade volatility and momentum. If you're leveraged and you're up 10% in 3 days, you take profit. You book the win, you pad performance. That kind of volatility doesn't tell you the peak, it tells you there are traders involved. So what are the real drivers? One of the biggest is central bank demand. We've talked about it before, but it matters. From roughly 1970 to 2010, central banks were net sellers of gold, different banks at different times. Even in the 1970s, after the US ended dollar convertibility to gold, the US still sold gold. Roughly 1,000 tons over that decade, taking reserves down from around 9,000 tons in 1971 to a bit over 8,000 tons by 1980. Then you had other sales. The UK famously sold in the late 1990s around $250 an ounce, not $2,500, $250, and basically handed it away. That moment is literally remembered as Brown's bottom because it nailed a multi-decade low. Switzerland sold a large amount in the 2000s, about 1,000 metric tons, and it sparked such backlash that there was even a referendum culture around stopping future sales. The IMF sold 400 tons around 2010. Some went to India, and the rest was never fully detailed publicly, but that era of big Western central bank selling largely faded. Since then, the direction changed. Central banks became net buyers. Not the same central banks. The big buyers have been countries like Russia and China, along with a broader list of emerging market and strategic buyers. Russia went from roughly 600 tons in 2009 to roughly 2,700 tons more recently, a massive increase. China's official numbers moved from around 600 tons toward about 3,000 tons, and a lot of people believe the real number could be higher because parts of their reserve management are not fully transparent. And it's not only them. Other countries have increased gold holdings too, from Central Asia to Latin America to parts of Asia, including some US allies. What that does is simple. It supports demand. On the other side, global gold output has been relatively steady around roughly 4,000 metric tons a year. You can still find gold, but it's harder, grades are lower, costs are higher, the mining economics get tougher over time. And Economics 101, if supply is steady and demand rises, price rises to clear the market. So central bank buying doesn't guarantee gold goes vertical tomorrow. But it can create something very important for investors, a kind of informal floor. No guarantees, but when gold drops hard, central banks tend to step in and nibble. They're patient, and they buy weakness. That creates what I call an asymmetric setup, significant upside, and in my view, more limited downside than people assume because large, price-insensitive buyers show up on dips. And there's another layer here. When the US and Europe froze Russian reserves, a lot of sovereign reserve managers around the world looked at that and said, what if Washington doesn't like something I do? Whether you're Taiwan, Japan, Saudi Arabia, or any country with massive reserves, hundreds of billions, sometimes near $1 trillion, you start thinking about what you can hold that can't be frozen as easily. And that's one reason gold has been getting more attention. Now, you'll hear the popular Wall Street narrative. The world is dumping treasuries, dumping dollars, the dollar is over, buy gold. I agree with the buy gold logic, but the rest is often exaggerated. We actually have data on treasury holdings through monthly reporting that tracks major foreign holders and their positions over time. And the broad trend has been far steadier than the social media version of the story. And this is where people get confused. They say the dollar is the global reserve currency, as if that means everyone is stockpiling banknotes. That's not how reserves work. Reserves are mostly securities things like treasury bills and bonds, not piles of physical currency. People don't always make the distinction between a currency and a security, and that's where a lot of sloppy narratives come from.